If you are an investor in Keppel Limited, ticker symbol BN4 on the SGX, you probably saw the headlines a few years ago. You remember the corruption scandals in Brazil. You remember the massive lumpy losses when oil prices crashed. You likely have a mental image of a company that lives and dies by the price of crude oil. And if you're holding this stock in your portfolio right now, every time you see oil prices wobble, you probably get a little knot in your stomach, wondering if the dividend is safe or if another massive write-down is coming to wipe out your capital. It is the classic legacy fear that plagues so many Singaporean blue chips. You look at the chart, you remember the history, and you think you know the story. But if you strip away the one-offs, if you ignore the noise of the past, and look at the hard data sitting on the balance sheet today, the real story is completely different. If that is your mental model of Keppel, oil rigs, lumpy contracts, and dirty energy, you are looking at a ghost. That company does not exist anymore. While the retail market was distracted, chasing bank yields and worrying about REIT consolidations, Keppel executed a surgical pivot that most of the market completely missed. They didn't just sell off their offshore marine business, they fundamentally changed the physics of how they make money. The headline isn't about oil anymore. It's about a 72% recurring income base. It is about a boring, predictable, fee-earning machine that is trading at a valuation that hasn't caught up to reality yet. This is a complex story, and it is the single most important transformation in the Straits Times Index right now. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, strip away the sensationalism, and show you what really matters for your CPF, SRS, and SGX portfolios. We don't do hype here, we do analysis. And we've been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context, so you can uncover hidden gems and potential pitfalls that the mainstream news simply glosses over. Today, we are going to do exactly that with a deep dive, point-by-point analysis through the new Keppel and why this boring transformation might just be the growth opportunity of the decade. Let's start our methodical breakdown by addressing the elephant in the room: the death of the conglomerate discount. 3 years ago, Keppel suffered from what we in the industry call the conglomerate discount. Investors would look at the sum of its parts, the property arm, the rig building, the infrastructure, add it all up, and then subtract 30% from the share price. Why? Because the business was messy. It was unpredictable. One quarter you make $1 billion, the next you lose it on a bad contract. But today, the new Keppel has effectively killed that discount, even if the share price hasn't reflected it yet. By the end of FY 2024, Keppel reported net profit from continuing operations of 1.064 billion Singapore dollars. But the headline number isn't the story. The quality of that income is the story. First, let's look at the most critical metric, recurring income. Recurring income now makes up 72% of net profit. In 2021, that number was just 21%. I want you to pause and really let that sink in. This is the single most important metric for long-term investors. The old Keppel had to hunt for new contracts every January 1st just to survive the year. They had to bid, fight, and scrape for every dollar. The new Keppel starts the year with hundreds of millions in management fees locked in before they even turn on the lights. This 72% figure is the alpha signal. The Singapore market loves stability. Just look at how we value our local banks. As Keppel proves that its earnings are no longer tied to the volatile cycle of rig building, the market will eventually re-rate the stock from a cyclical multiple of roughly 10 to 12 times PE to an asset manager multiple of 15 to 18 times PE. We are in the early innings of this psychological shift. Now, let's move to the second pillar of our breakdown, the mechanics of the capital recycling flywheel. This is the section most retail investors miss because it sounds like corporate jargon, but it is actually the secret sauce of their balance sheet. Keppel isn't just holding assets, it is aggressively churning them. The strategy is simple but ruthless: monetize, recycle, and scale. Since 2020, they have monetized over $14 billion in assets. They take illiquid legacy assets like old shipyards or non-core property that are just sitting there gathering dust. They sell them and then they inject that cash into high return funds like their data center or private credit funds. Why does this matter to you as a shareholder? It avoids dilution. Most companies, when they want to pivot or grow, need to issue new shares via rights issues to raise cash. That dilutes you, that hurts your earnings per share. Keppel is funding its own growth by selling its own junk. Think of this as housekeeping for profit. By moving assets of their own balance sheet and into the funds they manage, they achieve two massive wins. One, they get cash upfront to reinvest. Two, they earn a recurring management fee on that same asset forever. It is the ultimate financial alchemy. And it is the engine driving their target of $200 billion in funds under management by 2030. Next, we need to analyze the operational engine. Keppel has reorganized into 3 integrated divisions. This isn't just corporate speak. It's about synergy. Let's break down these 3 engines. First up is infrastructure. The theme here is boring is beautiful. They have moved from volatile power trading to long-term contracts. By the end of 2024, roughly 70% of Keppel's power generation capacity is contracted for 3 years or more. For us as investors, the bull case here is simple. This is now effectively a utility business hiding inside a growth stock. It provides the steady cash flow floor that allows them to take risks elsewhere. The second engine, and frankly the most exciting one, is connectivity. This is the AI play. This is the jewel in the crown. Between data centers and the Bifrost subsea cable, Keppel is owning the plumbing of the internet. Let's look at the stats. Their data center capacity grew from 650 megawatts to over 1.2 gigawatts planned. But it's not just about size, it's about the moat. They are building Singapore's first floating data center. This solves the massive land scarcity issue we have in Singapore. And more importantly, it uses seawater for cooling. In an era where AI chips are running hotter than ever and energy costs are soaring, having a natural seawater cooling advantage is a competitive edge that pure-play land-based DC operators cannot easily replicate. The third engine is real estate, specifically the Ermont factor. The acquisition of Ermont Capital, a European manager, was expensive at $1.4 billion. Many analysts balked at the price tag, but it was strategic. It instantly gave Keppel a foothold in Europe and access to private credit markets. Crucially, this diversifies them away from the struggling Chinese property market. If you are worried about the contagion in China's real estate sector, Ermont is your hedge. It balances the portfolio geographically and sector-wise. Now we have to address the uncle test. I get this question constantly from the community. Iggy, why buy Keppel at a 3.3% yield when DBS gives me 6%? It is a valid question. If you are a retiree, if you are an uncle or auntie who needs immediate cash flow to buy groceries or pay the utility bill next month, do not buy Keppel. Go buy a bank or a reliable REIT. You need income now. However, if you are an accumulator, say in the age range of 35 to 55, you should be looking at total shareholder return, or TSR. Keppel retains more cash to reinvest in those high-growth data centers and funds we just discussed. DBS pays you cash now, which is high yield but lower growth. Keppel reinvests cash to grow book value, which means lower yield but high growth. Keppel's management has implicitly targeted a 15% return on equity. You do not get 15% ROE by paying out all your cash as dividends. You get it by compounding. My view is to treat Keppel as your growth component in a Singapore dividend portfolio. It balances the stagnation of the telcos and the cyclicality of the banks. Finally, let's look at the valuation disconnect. Here is where the opportunity lies for the SRS and CPF investor. Keppel is trying to become the Blackstone of Asia, or a mini Macquarie. These are high valuation asset managers. But the market is pricing Keppel like a localized construction firm. Even if Keppel only re-rates to a 14 times PE ratio, which is still a discount to its global peers, that implies a share price of over $12.50. That offers a comfortable 20% upside from current levels excluding dividends. The market is lagging the reality of the business model. So let's summarize Iggy's assessment. What is working? The balance sheet is becoming a fortress. The pivot to recurring income is real and quantifiable at 72%. The capital recycling flywheel is allowing them to grow without diluting shareholders. The exposure to data centers and AI infrastructure positions them perfectly for the next decade of tech growth. What is not working? We have to be realistic. The yield is low compared to peers, which alienates a large portion of the SGX investor base. There is also execution risk. Transforming a giant industrial conglomerate into an agile asset manager is difficult culturally. And while Ermon provides diversification, Europe has its own economic headwinds that could drag on performance in the short term. Furthermore, the reliance on management fees means they are now tied to the valuation of the assets they manage. If global asset prices crash, their fee income will take a hit, even if it is recurring. Current valuation, it is attractive, it is mispriced based on old biases. So here's the final recommendation. For existing unit holders who have held through the transformation, hold. The yield is decent enough to wait, and the growth story is finally taking shape. You have endured the pain of the transition. Do not sell now just before the harvest. For new buyers looking to enter, if you are looking for a pure dividend play, wait. The risk reward for income isn't there. But if you are looking for capital appreciation and exposure to AI and infrastructure within a safe Singaporean blue chip wrapper, this is a buy. I would look to accumulate on any dips, viewing this as a long-term compounder rather than a short-term trade. If you found this valuable and want to go even deeper into the numbers, consider becoming a free or paid subscriber to the Investing Iguana Substack. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support allows us to keep cutting through the noise. Thanks for watching, and I'll see you in the next analysis.